welcome to Baku, Azerbaijan. You can probably see the flame towers in the background. I hope you can. We are here today to talk about taxation basis. What is taxation basis? This is basically how much, what portion of your income the country is going to tax, okay? So the two most common that you will hear about is worldwide taxation, which we're going to talk about in detail, and territorial taxation. There are variations of this, which might include a quasi-territorial taxation, and also something called remittance-based taxation. And then of course there's zero tax, right? So you could have zero tax. These are pretty rare. You have countries like UAE, which for most industries is zero tax. You have places like Cayman Islands, Bahamas, etc. But usually what you'll get is only specific company types that have zero tax, and that comes under our residency conversations we had in another video. So taxation basis works like this. Okay, so worldwide is very simple. Basically, all of your income worldwide gets taxed. Now, where this is a little bit tricky and the media screws it up is they will say, oh, you know, as an example, the US is one of the only countries that still has worldwide taxation. You know, say Canada has territorial taxation. Untrue, okay, untrue. Canada, about 70+% of the world has worldwide taxation. However, a lot of the world has what's called participation exemptions, or rules whereby they don't tax income from dividends of subsidiaries. Okay, so that's sort of a different thing. It's holding company regimes. It's a little bit different than what you have, than the actual taxation basis. So taxation basis is, hey, all of your income worldwide is going to be taxed, okay? Now, the next thing that we have is we have territorial taxation, okay? Territorial taxation is they only tax local source income. Okay, now as we discussed in previous videos, what constitutes local source income is a little tricky, okay? So for example, I'll be in Costa Rica, and I'll hear people say, oh, Costa Rica only taxes local income. I'm doing business online. My customers are in the US and, I don't know, Mexico, Brazil, Australia, Asia, somewhere else. Does not matter. They tax not based on where the companies are, but things like where the contracts are concluded, where the services are performed, where the sales take place. So it depends a little bit from country to country, but it is inaccurate to say that that's based on where the customers are. For example, let's talk about Hong Kong, since Hong Kong is a really common jurisdiction. Hong Kong is what's called the operations test. So if you have a Hong Kong company and you're living in Hong Kong, doing business in Hong Kong, you're probably paying tax on the worldwide income of that Hong Kong company, meaning no matter where the customers are, etc., because they use what's called the operations test, and if the operations take place in Hong Kong, they're taxable in Hong Kong. That's the way that it works, okay? So territorial taxation can be really good for you. For example, if you have a Hong Kong company, but you're not doing business in Hong Kong, you don't have any operations there, then you can be tax-free, potentially. You can have something similar in Gibraltar. Gibraltar has a kind of quasi-remittance-based taxation system. Singapore is a mixture of remittance-based and territorial. So it varies from place to place, but the majority of the world is worldwide. Now, as we discussed, so what's remittance-based? I'll explain that briefly. Remittance-based is they only tax money that comes into the country. So, again, keeping in mind that this can apply separately to a company and to an individual, okay? So how might this work? Well, if you have, for example, if you're dealing with Thailand has something where they've got different rules for individuals than for companies. So they'll have, say, territorial, or I'm simplifying this a little bit, but basically territorial for individuals and worldwide for companies. So a Thai company is worldwide taxation, okay? However, so let's go into their kind of like remittance-based thing. What they'll have is if you don't bring those dividends back for a year into the country, you don't have to pay tax on them. Okay, that's kind of their way of dealing with it. So again, it's what money do you bring into the country? Malta has this for some of their residency programs, okay? Like I said, Gibraltar has this, so you can't do business with Gibraltar persons, you can't use, say, Gibraltar banking typically. Singapore, with a Singapore company, you can't use Singapore banking without being taxed in Singapore. So it varies from country to country, but that's remittance. So remittance is, did I bring the money in? Territorial is, where is the income source? And worldwide is, all of it. Now again, that the territoriality worldwide piece that we can play with is, do you have some sort of an exemption for certain income? So some countries exempt income from dividends of foreign companies. Some do it if you're, I would say, a majority holder, but not if it's, say, a public company. Some do if you have a certain amount, say 10% that you've held for 2 years, things like this. So you have to dig into what those rules are country by country, but that's pretty much how it works. So the thing to be aware of is, be aware that territorial is not zero tax. Start with that. Territorial could mean zero tax if you're structured properly, but you could also, get into an issue. Second of all, understand what they mean when they determine what is that territory. How do we know what local income is? And then go from there. So if you need help, reach out to us. We deal with it all the time. We help people structure, and we will talk to you on the next video.